Today, I'm going to show you how to buy the right stock at the right time. By the end of this video, you're going to know exactly what to look for before you buy any stock. And then at the end of the video, I'll give you a link to download the same checklist that we use every day. Let's dive in. Buying a stock should feel exciting, but for most people, it feels overwhelming. There's thousands of stocks and so much data out there, you can spend hours researching and still feel lost. Worse, you buy something that looks good, and after you buy it, it drops. Why does this happen? Well, there's a few mistakes investors make, which we'll definitely address today, but the underlying problem is that you have no buying criteria. When you have no buying criteria, you're always left saying to yourself, what should I be looking for? When you say things like that, the downside is you just get buried with data. If you don't know what to look for, the market will give you plenty to look at. The market has a way of burying you with data, and you're left blurry-eyed after spending hours upon hours, and you're still left wondering, did I pick the right one? Or worse, you pick a bad one, but you think it's good. The reason I have a picture of pineapples here is because one time my wife asked me to go buy a pineapple. And I went to that bin at Walmart, picked out a pineapple, and I thought I picked a good one. And she's like, no, you picked the wrong one. I was like, what are you talking about? I picked the right one. And she said, no, you gotta sniff the bottom and it'll let you know if it's ripe. So the problem is, I thought I picked a good one, but I didn't, because I didn't have the right buying criteria to begin with. When you don't have the right buying criteria, you end up buying stocks and then holding on to bad trades too long. You end up saying things like I did with the pineapple. Like, I can't be wrong. I picked the right pineapple. It looks good. You'll say the same things with your stocks. You'll say, I can't be wrong. I did everything right. Or eventually, you're saying things like, it'll come back. So what we need to do is have and use the right buying criteria from the get-go when we're buying our stocks. You want to go into a trade knowing you made the right choice, that you picked a stock that puts the probability of success in your favor. We use a simple 5-point checklist before we buy a stock. By using it, you'll start buying stocks with confidence because you know they have a high probability of going up. Let's go through each of the 5. I'll teach you what they are and show you examples of each. At the end, I'll put it all together and show you how we do it here at VectorVest with our clients. Criteria number 1 is to choose sleep at night stocks. These will be stocks with a smooth and steady price uptrend. You want to put stocks in your portfolio that allow you to sleep soundly at night because you know even if the market moves down the next day, you'll be okay. Even though your stocks might go down a little bit, most likely they won't fall off the face of the earth. Think about it this way. When your stocks are calm, so are you. I like to draw it out first to understand the concept and then go look at examples. We talk to investors every week and they ask us what we think of their stocks. When we look at the graphs, many times they look like this over the past year. They'll have these wild swings up and down and just kind of move sideways. Or even if they're not just moving sideways, they might go up, but they'll still have these wild swings up and down and up and down. When you buy stocks with high volatility and a tendency to make big moves quickly like this, it causes you to make quick, emotional trades. You may never see the big run up because you sold it on a down day because you were afraid it was going to drop even more. Also, when you buy stocks that look like that, hoping for big gains, it also causes problems on exits, which we'll talk more about in another video. Instead of buying stocks like that, you want to focus on smooth and steady. You'll look for something like this. They'll still have ups and downs, but they aren't drastic. They work their way from the lower left of the graph to the upper right. When you do that, not only do you have a higher likelihood it will continue to go up, but it also makes it easier when it comes time to sell. Since you have a definite uptrend in place, it'll be easier to see when that trend ends. Let's take a look at a couple of examples. You want to avoid stocks like this. They may seem exciting and you may feel the stock is going to take off, but look at all those wild swings. It's like a roller coaster. That roller coaster won't end just because you buy it. Volatile stocks cause emotional trading, and emotional trading can kill your portfolio. Here's what you want to look for. It's smooth, steady, moving from lower left to upper right. It still has its ups and downs, but it steadily moves higher with low volatility. The key is to look for stocks going from bottom left to the upper right in as smooth and steady a pattern as possible. Criteria number 2 is to use Newton's first law. If you remember from school, Newton's first law says an object in motion stays in motion with the same speed and direction unless acted upon by an outside force. So you want to make sure any stock you buy is currently in an uptrend. Not only longer term, like 1 to 5 years, but right now. Investors make a common mistake, though. Investors will watch good stocks rising and they'll say things to themselves like, it's already made its run, it's too high, or I'll wait for it to pull back. So they wait for something to happen to a stock, then buy it as it's falling. Then that body in motion stays in motion, moving down, and the stock they bought continues to fall. They keep holding on to it, saying things like, it'll come back, and I'll just give it another day. A more drastic example is when people buy stocks that look like this. Keep in mind, this type of stock could have been one of these at one point. Even if these stocks start to move higher, there are just so many areas of resistance where prior buyers are just waiting to sell. Think about it. Have you ever bought a stock, watched it drop, and said to yourself, if it ever gets back to where I bought it, I'm going to sell it? That's what previous buyers are saying when the price gets to here, and here. So instead, you're going to look for stocks that look like either of these two. First will be a stock that's just steadily rising and continue to rise, or a stock that was steadily rising and pulling back, but you won't buy it as it's falling. You're going to wait until it starts to go back up. That's the concept. Here are a couple of examples. Here's one where the stock was rising, but now it's falling. You know the uptrend is over and a downtrend has begun because you see a lower high and a lower low. Many people buy it now because they were waiting for the stock to pull back. But remember Newton's first law. This stock is in downtrend. This stock here might look like another example, but it's actually the same stock. It just continued to move lower and lower. But new investors also see this stock and try to catch the bottom. They say, well, how much lower can it go? But if you buy it, keep in mind, all those people who bought it back here, or here, or here, who were also trying to catch the bottom, are just waiting for the price to get back to where they bought it so they could sell it. Instead of buying a stock that's full of unhappy investors, buy a stock where there are no unhappy investors and it is nothing but enthusiastic buyers. Price should be making higher highs and higher lows. So remember Newton's first law and don't fight the trend. Criteria number 3 is to check the earnings engine. Earnings is the engine that drives stock prices higher over time. It also helps stack probability on your side, that the stock won't move adversely or quickly against you. Just like before you buy a car, you check the engine. If it has a bad engine, you don't buy it. A good engine is one criteria that's required. Here at VectorVest, we calculate a leading 12-month earnings forecast. by compiling all the earnings data available, including historical earnings, recently reported earnings, along with company forecasts. We put it into one extremely accurate 12-month earnings forecast. Simply look for the EPS to be steadily rising over time. Remember, earnings is the engine that drives stock prices higher over time. When you combine the first three criteria that we just looked at, you will be selecting stocks that look like this. You'll have price and earnings working together. Doing that will really start to build confidence that you picked a good stock. The last two items on the checklist help make sure you're buying a good stock at the right time. This will stack the probability of success in your favor even more. Criteria number 4 is to ride the wave. Make sure you only buy when the overall market is trending higher. It's so much easier for surfers to ride the wave in than it is to swim out against the current. You could be the greatest swimmer in the world, but if you try to swim against the current, you won't get very far. The same is true for good stocks. Even good stocks get pulled down when the overall market is falling. So wait for the market to be rising and then buy those good stocks. Most investors are taught it all wrong. You were probably taught, the market always goes up, so just buy and hold. You can't time the market, so it's always a good time to buy. Or, when stocks go down, it's a buying opportunity. That advice leads to disastrous consequences. The stocks you buy tend to drop right after you buy them. It leads to a portfolio roller coaster ride with slow moves up and fast moves down. And the drops in your portfolio take years to recover from. The market's trend is the single most important thing you need to consider when buying your stocks. We agree, no one can predict the market. However, you can identify the current trend. You need to make sure you trade with the market, which we call riding the wave. When the market's trending up, consider buying. When the market's trending down, don't buy. It's that simple. You're putting the odds of success in your favor. Here's a look at the difference it can make for you. Here are two portfolios trading the NASDAQ ETF QQQ. The top one shows buying only when our market timing signal was up. The other was buy and hold. By trading with the market, you reduced your drawdown, steadily grew your portfolio, and doubled your gains. Criteria number 5 is to watch for follow-through. At this point in the checklist, you've gotten a signal the market's in an uptrend. You've found a good stock. Next, you make sure the stock and the market are moving higher the day you buy. Follow-through is evidence the price move is likely to continue. For example, if you're preparing at night or before the market opens, you would wait until after 10 a.m. Eastern Time and make sure the overall market and your stock are moving higher after the open and higher than they closed the day before. You want to avoid buying stocks that are moving lower. Let's look at how we do it using our Market Launchpad product. We designed Market Launchpad with the prudent investor in mind to help you build what we call the double every 5 portfolio. A portfolio that grows predictably, protects your capital, and gives you confidence with every move. As soon as you log into VectorVest Market Launchpad, you'll see the market timing signal right at the top. You'll see one of 4 scenarios. It'll either tell you it's safe to buy, or if you should be getting ready to buy, or if you should just hold out and wait, or if the market's trending down, it'll tell you to be defensive. If it's green and it says it's safe to buy, or yellow and it says to get ready, you can begin to look for buying candidates. And right here inside of Market Launchpad, you can see we also included the Safe Stock Selector checklist, which you could use. But finding candidates is as simple as this. Once you know it's safe to buy in the when to buy area, over here on the right, it says what to buy. And we give you a couple of searches which do virtually all the heavy lifting for you. For example, I'll click on this first one here. And you're immediately shown a list of great candidates. From here, just simply click on the first one in the list. And over on the right-hand side of the screen in the quick view, you'll have a mini graph of price and earnings, the two big pieces of the buying checklist. And simply look for the smooth and steady pattern of price and rising earnings. Just go down through the stock. So here I'm going to go from this one, go down to the next one, and just keep going through until you find one that you really like. For example, you come to this one, bottom left to upper right, rising earnings. When you see one that you like, simply add it to a watch list and just keep going through, building a watch list of all the ones that you like. You can even click View Full Graph, and you can continue to scroll through, looking at graph by graph, looking for bottom left to upper right price action. Today, we looked at 5 criteria to help make sure you are buying the right stocks at the right time. Which one resonated with you the most? If you want a copy of the checklist that we talked about today, use the link below. It'll give you everything that we just talked about in a one-page checklist. I recommend printing it out and putting it right on your desk to use every time you buy a stock in the future. I'll see you in the next video.